We're joined today by Mr. John Bollinger. He's here to give us his thoughts on the market heading into the elections and some key signals that we need to be mindful of and monitoring as the elections hit and then in the months that follow. John, I'm going to turn it over to you. Thank you so much for being with us.
Thanks for spending some time with me today, Jason. I know that the election's on everybody's mind, but I don't think that the market's really too concerned about the election right now. I think the market's probably more focused on the economy and what path the Fed is going to take. But I brought along sort of the basic TrendSpider workspace that I use to look at stocks and indices and such like that, and a small list of indices, starting with the S&P and running down to a couple of equal weighted indices. And my point here is pretty simple. This market's pretty strong, and it's staying strong. So what we see here is a chart of SPY. Again, I much prefer looking at the tradables rather than the indices. And I have daily and weekly Bollinger Bands on here. This was the feature that first got me interested in TrendSpider, this multi-time frame analysis on one chart. I find it a huge time saver when I'm trying to run through a lot of ideas. So here you see the SPY. It's the S&P 500 ETF making a new high and really nicely confirmed by %B. That's that middle clip in the screen, middle of the screen there. You can see a series of higher lows in both the daily and weekly versions. And, this is just a very strong market that's well confirmed.
Yeah, what's your perspective on that? Why does the market not care? It's just simply all about interest rates. Do you think that the market will start caring at any point?
I think it probably will start caring, maybe closer to the election. I think the fact that the polls are so tight is part of the reason the market really can't figure out where the advantage is. That's just a guess. Normally, I like to look at the betting results. Interactive Brokers is currently running betting on the elections, and there's numerous other sources. Over the years, those market-oriented views of election results have proved to be very accurate and very useful. But they're virtually a push. Depending on which series you're looking at, one might have a tiny edge over the other. But there's no clear advantage. Meanwhile, I think that there was a lot of worry about the economy. And the market's much more concerned about that. And sort of as a secondary thing in that worry about the economy, they're really focusing on the Fed. But let's just step down and look at a couple of these charts. This is SPY, so this is large cap. This next one is MDY. It's the S&P 400, and it is mid cap, and you can see it is out to a new high as well, and shows exactly the same pattern that we're seeing in the S&P 500. Higher highs and higher lows, both in absolute terms and in relation to the Bollinger Bands. And I really like structures like that. So as you get down in cap size here, we get to a much tougher chart. It's still a good-looking chart, but it has not been able to break to a new high. This is the S&P. The ETF based on the S&P 600 small caps. And we look at a similar situation if we go down to the microcap ETF, but it's even more range bound. So, people are making bets on the big companies that they know and understand. The top 1,000 companies are covered by the S&P, SPY, and MDY, but you get down into small stuff, and people just there's more uncertainty there. They're not really marking them up. I also like really to look at these equal weighted ETFs. This is the S&P 500 equal weighted ETF. Everybody's been super concerned about only 3 stocks are driving this, or only 2 stocks, or 5 stocks. You pick your number, whatever the worry is, but I don't think that it's that big a problem, honestly. Here's a equal weighted S&P 500 ETF, and you can see that all 500 stocks are pulling in one way or another here. They may not all be making new highs together, of course they're not, but there's no divergences here between this and the cap weighted version. When you get those divergences, that's a big worry. And then you zoom out a little bit. This is the Russell 3000, the top 3,000 stocks in the market. It's at new highs and a very similar pattern. And then finally, I really love this. I love this. It's probably my primary market tool. If I just want to find out what's going on in one shot, I come here to the Invesco Russell 1000 equal weighted index. So this is an equal weighted index of the top 1,000 stocks in the market. NVIDIA is not driving this, right? The average stock is driving this, and you can see it's a very constructive pattern.
One thing that I notice across all of these charts, at least on the daily, the bands are tighter than they've been in months. You got to look back to like June or July to see the bands as tight as they are right now. What is your read on kind of that setup?
So we call that a squeeze, or we're approaching a squeeze. Going back to SPY, you can see a really low level here. But if you look at the weeklies, it's nowhere near as low on an absolute basis, but it is as low on a relative basis. So generally these periods of compression like this lead to some form of release, and most people like to think that it's a forecast for prices to move lower, but in this case it's forecast for prices to move higher. And you can see it as you flip through these guys, it's the same for all of them. There's a lot of compression, and we're just breaking out of the upper band for all but the two smallest of even the equal weighted ones are breaking out of the upper band. So the big question, of course, on everybody's mind, we're investment managers. We're classic RIAs, and when the small caps and the mid cap and the mid caps go, they really go. So that I think the big question is for everybody is when participation is going to broaden out. And in terms of the election, is that something that's more likely to happen under Harris or happen under Trump? I have no forecast in that regard.
What visual cues should traders be looking for on those charts using Bollinger Bands to identify that they are kind of making that move that you're looking for, and that move is like sticking?
So let's go back to SPY. So we call this a walk up the upper band, and it's pretty well confirmed. You can see it's walking up both the daily and the weekly upper band. So until you see some separation from that, we would, in technical terms, we call that a type of divergence. Until you see some separation, prices can and do walk up the upper band for extended periods, and there's no sign of separation yet. So if you look down a little bit further, the equal weight here is doing exactly the same thing, and the Russell 3000 here is doing exactly the same thing. So the support is very broad here.
How exactly do you define separation?
Oh, literally just price separating from the upper band. You can see that we're actually out above the upper band. When you can you see my pointer here?
Yep.
Oh, okay. So right now, percent B, which tells us where we are in relation to the Bollinger Bands, is well above 1, which tells us that we're trading above the upper band. And you can see that back here we tried to break out and failed, just pulled back to the middle band. That's a very normal bit of activity, right? You get a little bit ahead of yourself, and prices consolidate and pull back toward the middle band, such like that, and then start back up again. That's very bullish activity. So separation would look like you run up here a little bit, and the band expands even higher, and you find percent B down here messing around with 0.5 or 0.6 or something like that. That would be the first alert, and then you would want to start paying a lot more attention.
Okay, gotcha. Is there any significance to when your lower time frame band eclipses your higher time frame band, kind of like we saw in maybe late July, kind of late August?
Oh, that's a great question, Jason. I don't know. I'll have to study that.
Okay, right on.
You know,
Just curious.
there's a whole bunch of people that use Bollinger Bands and Keltner Bands together,
Right.
Or Keltner channels, they like to call them. And when the Bollinger Bands are inside the Keltner channels, it's that sort of situation that we're in now, where you have a squeeze and it's a forecast for higher volatility.
Right.
So the relationship of bands with other types of bands is an area that's proved to have a lot of value in the past, but I've never really studied that particular aspect. I will be looking at that.
Yeah, that would be interesting to know. Maybe we could go through some of your market timing charts.
Okay, so each week I produce something called the Market Timing Chart Pack, and it's 50 classic market timing tools. Some of them you'll be familiar with, some of them you probably won't be familiar with, but I post it on my website each week, usually on a Saturday or sometimes on a Sunday, and it's free. You can just download it and flip through the charts and get a feel for what's going on out here. I'm going to skip a lot of charts because there's 50 of them. We don't have all day to explore. But this first one is exactly the same chart that we were just looking at. Is the S&P 500 with percent B beneath it, and you can see that there's no divergence whatsoever. And today, with us breaking the upper band, it will actually, percent B will be at a new high with price confirming. So and here's that situation you were asking about. The bottom clip is bandwidth, which tells us how wide the bands are, and you can see at 3.48, that's very narrow for the S&P 500.
Right.
Basically anything under 5 is pretty narrow, and the further you get down there, the greater the compression is, and I think the greater the release. And currently we're seeing compression and release to the upside. Now, this is a little bit of an esoteric chart, but I put it here because I wanted you to look just at one little aspect of it. If you can you see my pointer here?
I sure can.
So this blue line right here is called on balance volume. It's a market timing tool created by Joe Granville, and each day it either adds volume or subtracts volume based on whether price is higher or lower. And you can see that for the past month, it's just been chopping sideways, and we've been up and down, 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 and that's a very unusual pattern. There's actually a technical indicator designed to show that. It's E.W. Dreise's choppiness index, but this tells me the degree of uncertainty that's out there. People don't know what the election result is going to be. People don't know how the economy is going to behave. People don't know what the path of interest rates are going to be, and they're battling it out in the marketplace every day. So that's when you get this alternation of up and down days like that.
Right. Interesting.
Yeah, I thought it was super interesting. When I saw this chart this weekend, I went, aha, that's exactly what I've been feeling, and that really confirms it. So this is the VIX in the lower clip here. It's running a little higher than I think it should be, given the strength of the market, and I think that's basically people making bets on the downside and/or buying insurance. So I think it's a reflection of the sort of uncertainty we're seeing in the market.
Why do you think it's running hot? Just out of curiosity.
I think it's people buying puts. Honestly, I think it's just that simple. The put side of the equation is really what drives the VIX, and I think that there's a lot of put activity out there. One can't ignore the fact that there's a huge amount of this zero DTE, 0 day to expiration trading in the options market these days, and so many of these indicators that are based on option premiums and option trading are stressed. So that could be part of the problem too.
Are there any particular signs with VIX that you would be looking for, warning shots, I guess, or like what would perk your ears up if you saw happen on the VIX?
I don't know if the VIX got down to 10 to 12, I would get really nervous. I think that's the biggest takeaway, because that would mean real complacency. That would mean really everybody had bought into the bull market scenario, and with the election coming up, well, the election's going to be a focus point. So if we were to arrive into election day with a very low VIX, I would be very cautious.
Interesting. Okay, we'll have to be keeping a close eye on that here over the next month and a half, huh?
Yeah, I'm going to skip a couple charts here and go to this one. This is the advanced decline line for the S&P 500. It's not. Usually we look at it for the New York Stock Exchange, but this is for the S&P 500, and you can see it's confirming the strength that you're seeing in price. And then we already looked at this. This is the lower clip is RSP. That's that equal weight version of the S&P 500. You asked about this before, so this is a great way to see this by plotting them both together. If they have the same pattern, then everything's fine. If they have different patterns, then it's a big alert, especially if RSP is falling off while the S&P 500 is climbing.
Yeah, that makes a lot of sense too.
Yeah. So you kind of saw that in here coming into this decline. You had the S&P rolling and RSP going sideways, right?
Mm-hmm.
So it just tells you that there's some internal weakness in the market. So this is just growth versus value. People favoring growth here. This is consumer discretion versus staples. Again, all of this is based on tradables. Everything in there is that can be is based on tradables. So people are really starting to believe in the consumer here and better outlook for the economy. I'm going to skip these because those are a couple that are pretty hard to explain in the short term. But this is a really interesting chart. So this is some work by the late great Jim Alfier. He did this thing where he, in different time frames, he counted the number of up days versus the total number of days. So that orange, I'm sorry, the fuchsia line is the longer term indicator, and the blue line is the shorter term indicator. So the fuchsia line tells us that the market's been steadily overbought for quite a while and progressing, and then you see the shorter term activity swing around that, and that's exactly what you expect in a bull market. You expect that intermediate to long term of bull markets, going to stay fairly overbought, and that short term you're going to get some noise around that. You're going to get some pullbacks and such, so you know what to do.
Interesting. I've never seen this chart before.
Yeah. The original paper appeared in Barron's maybe 40 years ago. He called it urgent selling, and they followed it up 2 years later with another paper called prolonged selling, which is a longer term version of it. And then we've combined them into this, and we look at both the buying and selling sides. Jim was only concerned with the selling side, because he was primarily interested in playing defense. So
do you have any concern with the negative divergence that you're seeing on that shorter term chart? Lower highs versus higher highs on the index there?
No, it's what we expect to see. It just I would expect what would get my attention here would be if both would start to roll off.
Got it. Okay.
So New York Stock Exchange advanced decline line, confirming price. No divergences there. These are a couple of breadth oscillators. They measure the activity of advances and declines versus up and down volume. Dead neutral here. They're neither overbought nor oversold. Can't explain that in short term. RSI here, very interesting. There's a lot of work been done on RSI in terms of the ranges it's trading in as a forecast for whether we're in a bull market or bear market. So you see 3 sets of lines here instead of the classic 2 sets of lines. Normally, you would only look at the 30 and 70, and you just automatically say 70 was overbought, 30 was oversold. But we've added 20 and 40 and 60 and 80 because in a bull market, right, 40 and 80 become the proper references. And in a bear market, 60 and 20 become the proper references. And if you just look at what ranges we're trading in, that'll tell you whether we're in a bull market or bear market. So clearly here, over the past year, we've been in the upper portion of this range. We've only been under 40 twice. Most of the time, we've been over 60. So that's clearly bull market behavior.
Fascinating. Never heard that before.
Yeah, there's wonderful guy. I'm spacing his name right now. He passed away about 2 years ago. Who was the primary driver of this type of analysis? Wow, just can't remember his name. It'll come to me.
Yeah, that's all right.
MACD turning up from a high level, that's always pretty bullish. It takes a lot of market strength to turn MACD up from a high level. This is the McClellan oscillator. It dipped into negative territory here, but the best tool here is the McClellan Summation Index, and here we use Jim Miekka's calculation, and this is just very strong up here in the 1600 area. That's again, you only get there in bull markets. It's
why is this the best tool to use?
Because this is just the McClellan oscillator, which the summation index is based on, is just a much shorter term tool. It's a much noisier tool, and one that you really have to pay a lot of attention to use properly. But the summation is it's a much simpler tool. At very high levels of it are very bullish.
Got it.
So it's just easier to use, but there's a lot of value in the original McClellan oscillator itself. So Greg Morris wrote a pretty interesting book on market timing indicators and such like that. And the bottom line from his analysis was that this was his favorite. This was his number one choice. So you see new highs and new lows here. We're running, a surplus of new highs. That's exactly what you'd expect to see. So this is a really interesting index. This is one of the oldest broad market indicators around, developed by Abe Cohen of Chartcraft fame, probably in the 1940s or so. It's a ratio of the number of stocks making new highs to the number of stocks making new highs plus the number of stocks making new lows. So running up here in the 85% range, it's just very strong. It's showing no signs of divergence here.
Would we be watching a break below that moving average?
Yeah, and more importantly, a pullback which drove it below 30 would really be and you can see in both of the prior pullbacks this year, it remained well above 30. But the more troubling pullback in October of last year, it actually was able to get below 30.
Yeah. I mean, those look, just from this chart, those look like excellent buying opportunities below 30.
Yeah. Let's see. Let's just skip it. You know, we don't have all day here, so let's skip a couple of these. Bullish percent. This is another older technical tool, again developed by Abe Cohen at Chartcraft. Those were the people who brought you the 3-point method of point and figure, and they had a subdivision called Investors Intelligence, and produced a lot of surveys and such like that. We'll get to one in a minute, but this is simply the percentage of stocks that are on point and figure buy signals. So at 61, 62, which is where we are now, that's very strong. So it tells you that the participation in the market is very good.
Can you give us a brief explanation of point and figure?
Can I do heart surgery? And yeah, point and figure is really an elegant approach to charting. It ignores time. It just focuses purely on price. And when price is rising, you put a column of X's going up the piece of paper that you're charting on. And when price starts to fall, you put a column of O's. So a point and figure buy signal is when a column of X's exceeds the prior column of X's. So it just means that price has made a new high relative to its prior high.
Got it. Okay.
It's a shorthand form of charting. Comes from back in the day when maybe the late 1800s, early 1900s, when people who were traders on the floor, or before there was a floor, outdoor traders would mark just the figures, the point, aka 10 point, and the figure a quarter, right? They would mark the point and figure on a little piece of paper in their hand, right, to keep track of where price had been, because maybe they were making markets in 10 or 15 different items, and they just flip between the cards and see what they needed to do when an order came in.
Got it. Okay, cool. So, that's what I thought.
Yeah. Point and figure, right? The 10 today we don't, it would be 10 point, and a decimal, but back in the days it was eighths and quarters and halves and such like that.
Right.
This is a little hard to see chart, but it's the way I like to look at it. This is the AAII, the American Association of Individual Investors. This is their sentiment survey. They do it once a week on Tuesdays. The green bars are the percent of people who are bullish. The red bars are the percentage of people who are bearish, and the black line is the net of those two.
Mm-hmm.
Right, and then a little moving average. So, what this says right now is the typical investor here is bullish, but not crazily so.
Yeah.
And this is the same thing we talked about. Abe Cohen's Investors Intelligence. This is a survey of investment advisors. In fact, it used to be purely market letter writers back in the days when market letters were the primary way of distributing stock market opinion. So again, the green bars are the number of writers that are bullish. The red bars are the percentage of writers that are bearish, and the black line is the net. So at 30, again, it's bullish, but not ridiculously so.
Yeah, cautious almost.
Yeah. Well, here's caution for you if you want.
Okay.
Here's caution. So this is NAAIM. This is a group of active market timers, professional investors. It's a National Association of Active investment managers. There we go. Every Thursday they publish the percentage of the percentage that on average that their members have committed to stocks. So currently they're 90% invested, and it runs from 0 to 200. Actually, it could theoretically go negative. I've never seen it go negative. Were they to be net short. But again, this is a very, very strong market, and they're sitting there at 70, 80, 90% invested. That goes back to what we're talking about with the VIX and all of that. I think there's an overabundance of caution in the market, which is a good thing for stock prices.
Would you consider this kind of like under invested, or is it just kind of moderately so?
For them, it's under invested.
Okay.
On a relative scale, but they'll go to 150. I mean, they're active investment managers, so they'll employ leverage. Right. So I think that given how strong the market is, this is underinvested. Obviously, for your typical person, this is very invested. But these are professional market timers. Right?
Yeah, that really have to be invested at all times in some way, shape, or form.
Yeah.
Interesting.
Exactly.
Interesting.
So I'm actually going to skip these next 3 slides because these are all based on put and call activity. And I think they've just been hopelessly distorted by all the zero DTE trading. And we need to work out a new set of indicators here that'll help us. But just noise right now as far as I can figure out. And I've been working hard on trying to figure out how to create some new option indicators. But I haven't solved that problem yet. So this is a proprietary thing that I do. This is how to explain it. So we have inverse ETFs, right? And there's a lot of interest in them. So this depicts the volume in inverse ETFs on a relative basis. So when nobody cares at all about inverse ETFs, it'll be down around 100. And when they're buying the inverse ETFs like Armageddon is upon us, it'll be 300, 400.
Got it. So
for some reason, I've never figured out, it seems to have settled out at about 200 on average. So I should actually just do a relative calculation, set that 200 to 100, and it make it easier to interpret. But this is what it is. So again, this is way more inverse activity than you would expect, given the strength of the market.
Right. So signals really at the fringes.
Yeah. So this is the next bit is the dollar, and so some other stuff. But this I think is pretty interesting. So we do Norgate data. Calculates advanced decline numbers for many of the indices. We saw it before for the S&P 500. So here it is for the Russell 1000, and you can see that the advanced decline data here is quite strong for the Russell 1000. And then beneath that, in the red and the green and red, green is the number of stocks making new 52-week highs, and red is the number of stocks making new 52-week lows. So last Friday, 132 stocks in the Russell 1000 made new 52-week highs, and none made new 52-week lows. Again, pretty on balance.
Yeah.
And we repeat that for several indicators. For several different indices, but I think this one is particularly telling because this addresses a lot of people's concerns. This is the Nasdaq 100, and you can see it's quite strong. The AD line is quite strong in new highs and new lows, but this is the Nasdaq Composite. So it's got all the smaller stocks in it, and it's in much worse condition. So people just aren't, there's just not belief in small cap stocks. And I think again that's a function of uncertainty.
Does that surprise you though, with the outlook on interest rates?
No.
No. Do you have any opinions about interest rates?
I think interest rates are going to continue to go lower. I think the Fed correctly understands that it's short-term interest rates are above equilibrium, and they're going to pull them back to equilibrium. I don't believe that the Fed is loosening here, particularly. I think it's trying to get back to equilibrium so they can get back into balance and resume normal operations instead of having to fight either deflation or inflation.
Yeah, right.
But that's that's just opinion. What we pay attention to is the price of stocks.
Of course.
There's a Nasdaq Volatility Index running in 23, 24 here. Again, that's pretty high for it given the strength of the market. Same comments as before. So this is a very hard to read chart, but it's one of my favorites. This is the relative performance of the market sector ETFs plus a couple of other items. So they're colored by the 1 week change. So transportation were the strongest one last week.
Right.
And utilities were the weakest one last week's. And then they're arranged up and down on this grid by the 1 month rate of change. And they're arranged left to right by the 6 month rate of change. So most of everything is sitting up here in the upper right hand quadrant, which means that they've been going up, and you can see that there's a few that are having a little trouble. Real estate, health, biotech, consumer staples are underperforming, but the core of the market is in there: industrials, tech, finance, large cap, consumer discretionary, transports. They're all sitting there. So that's a pretty healthy picture.
Are there any scenarios that you would be particularly watching for here? Certain sectors kind of making a sharp move in one direction or another?
So these guys rotate through this space here.
Yeah.
In a bear market, you'll find them all cowering in the lower left. In a real giant bull market, they're all clustered in the upper right, and they rotate through it. So you're starting to see a little bit of that rotation here. You've got a few that are dropping down, but nothing is really moving right to left. That's what would really worry me.
Got it. Okay, that makes sense.
So these are commodity prices. I think they're pretty important here. The black line there is an equal weighted commodity index that I calculate. It's got 19 commodities, and it's been strong here. And I think that's a reason for concern on the part of the Fed. Commodity prices being as strong as they have been. So I would use this to argue that the next cut's going to be limited to a quarter point.
And that seems to be becoming more and more consensus.
Yeah, and in this case, I think the consensus is pretty good. So this wants a long explanation, which we don't have time for. But suffice it to say, this is the way the Dow Jones Industrial Average was calculated prior to 1982. We call it the theoretical Dow. It's all the highs of all 30 stocks are used to calculate the high of the average. The lows of all 30 stocks are used to calculate the low of the average and close. Because prior to 1982, we didn't have any real-time data, so there was real-time calculation of the averages. But it actually proves to be very, very handy because the way the close sits in relation to those two data points works very well with these volume indicators. And this is the volume indicator you see beneath it is intraday intensity, was created by David Bostian, and you know we're solid green here, so there's no divergence. You keep on asking about what it would take to change my mind and stuff like that. We get to the upper here, and this is negative. This is in red territory. That would be a huge alert.
Okay.
But as long as we're running along here in green territory, there's just not that much to worry about. Let's skip that one. Here's a chart of rates. You know, I mean, we got the 3-month through the 30-year and the 2s versus 10s. So, you know, we're finally back to positive relationship in the 2s versus 10s. And as you know, this is going to assume its normal shape over the next few months as the Fed relaxes short-term interest rates and such like that. I don't think that there's a lot of information here for investors to be concerned with. And then, you know, these are some world markets. I like to see what's going on in the rest of the world. There's that giant spike in China. You know, they said we're going to, you know, get behind the market. We're going to get behind the economy. We're going to do what it takes. And so, you know, we had a few days of upside, but they had a big 1-week market holiday. It's their most important holiday of the year, and they came back and they had one more day to the upside now. Now they're unwinding all that.
Yep.
They're unwinding a good bit of it. But you can see that other than China, the rest of the world markets are pretty much in gear. My one worry here is the UK. The FTSE 100, which is what that index is, has proven in the past to be a pretty good leading indicator, and I would really like to see it rallying to confirm the strength in the U.S. market, but it's not. So this is a clear cautionary note for me.
Got it. Okay, interesting.
So let's see. I can stop sharing my screen here.
You know,
So,
go ahead. Go ahead.
No. Got questions?
Yeah, I'm curious. You know, you spoke about, or it seemed like a main focus for you is that market participants are not quite all on board with this bull market. Markets are rising, and there's still, it feels like there's a bit of concern. There's people on the sidelines. Are there any other periods in history? You've been at this game for a long time. Are there any other periods in history where coming into an election, markets were behaving in a similar way?
That's a hard one to answer without actually doing a specific study, which I didn't do before this. But in a general way, we say that bull markets climb a wall of worry. And that's exactly what we're seeing here. We're seeing that wall of worry. We're seeing uncertainty about the economy. We're seeing uncertainty about the path of rates. We're seeing uncertainty about the election, and we're seeing huge uncertainty about the global situation. I mean, I just mentioned the Middle East and Ukraine and this new axis of power that's building up with Putin and Xi and North Korea and possibly some other leaders joining. So I think that there's a tremendous amount of uncertainty out there, and I think there's a lot of money on the sidelines, yeah, and I think that's all probably pretty bullish until it isn't. But you know, we talked a lot about those divergences and stuff like that, and that's how you tell, you know, the until it isn't part.
Yeah.
You know, right now we're pretty well confirmed. We've flipped through those charts really quickly and skipped a few, but even if you take, you know, some time to do it, which I do over the weekends, there's just not a lot to worry about in those charts. There are a few exceptions, but there are always a few exceptions.
Of course.
So, But you know, if people want information on the market, I would really tell them to focus on these these election markets that are driven by betting. The Iowa markets in the past were the classic ones that the academics studied. But this year, Interactive Brokers is hosting very active betting on. They have two series that are super active. One Harris takes it, one Trump take it, and they're slightly at odds, which is really interesting. Right? It's got to be one or the other. Yet, so, and I think that's further sort of indication of the uncertainty. Plus, those markets right now are quite new. So I don't know quite how much we can trust them, but I do like real money being spent on outcomes. I think, you know, it gathers information.
Yeah. They've definitely proliferated here in the near term recently.
Oh yeah. There's a ton of activity out there, and there are sites out there that aggregate it all, and you know, so if you want to dive in, the water's plenty deep.
Yeah, I have to ask, do you have any sense on who you think is gonna be the victor here?
No, I thought after the Harris announcement, the Biden Harris announcement, the change in candidate, such like that. You know, she had initial very strong momentum, and you know that looked like it might carry through, but it hasn't really, at least not in the polls and not in the betting markets. So I have absolutely no idea.
All right, last question then.
It's funny, you know, I had a sense 2 elections ago, I had an odd sense that Trump was going to win. I thought it was just such an outlier sort of thing that it seemed plausible to me that it might happen. But I have absolutely no sense of this one.
What about particular names going into the election or maybe post-election? Is there anything aside from those key indexes that you kind of went over at the beginning? Are there any names that are sticking out to you as, you know, just names that you're particularly interested in?
Well, you know, we in a little pre-interview before we did this, we talked about NVIDIA, and you know, everybody was betting that NVIDIA was done, but it doesn't quite look like it's done, right?
It sure doesn't.
I like the leadership here. I think you know you should stick with what's working, and I really mean that. So when it's time for smaller stocks, I'm you know, I'm all over them. But I don't think you should be buying things that are just basing, or you know, I think in this type of market where uncertainty is as high as it is, you really need to own the leadership.
Got it. Okay. Right on. Well, John, thank you so much for your time today. It's been really fascinating going through all your charts and getting your perspective on things. We really appreciate you being here with us. It's been great.
Oh, my pleasure entirely. Thanks so much for having me on.
All right, John. Thanks. Have a good one.